Tesla gets set to report earnings this week, and according to Wedbush, all eyes will be on its profitability outlook and the margin profile in this quarter. In early July, Tesla posted record deliveries for the second quarter that surpassed expectations. However, my next guest says, quote, "This is the biggest single stock bubble." Joining me now is Mark Spiegel, managing member of Stanphyl Capital. Mark, good to see you. So since the start of June, over the last couple of months, we've seen some pretty strong gains for the stock to the tune of around 40%. So does that sort of positive price action give you cause for concern, or are you using it as an opportunity to increase those shorts?
Well, I can't really use it as an opportunity to increase the shorts because I've got a pretty big position. And in fact, as the price goes up, I tend to take a little bit off just to control the overall size of the position as a percentage of the fund. But it's not telling us anything fundamentally meaningful, the fact that the stock is up. I mean, for instance, people have talked about this so-called record quarter that they'll report this week because it was 95,000 cars. Well, in the fourth quarter of 2018, which is the previous record, using that metric, when they sold 90,000 cars, they actually had more revenue significantly, like hundreds of millions of dollars more revenue than they're going to report this quarter. So what I'm saying there is the only way they've maintained volume is by cutting prices on the cars. And, listen, if you keep cutting prices enough, you can keep up volume. That doesn't mean you're going to make money.
So one analyst from Morgan Stanley wrote recently that Tesla is fundamentally overvalued but strategically undervalued, suggesting that potentially there's serious long-term value within the electric vehicle market. And given the fact that this is such a growing market, I wanted to get your thoughts to that point.
Well, yeah, that's nonsense. So strategically overvalued, it implies that there's a buyer for the company. That's essentially what that means. And, Tesla has $10–11 billion of debt, tens of billions of purchase obligations to Panasonic and all kinds of other liabilities out there. There's no way a car company is going to trade at anywhere near the value of the debt, much less the equity, which is another, $40 billion or something like that. Maybe it's in the 40s now. So that's just pie in the sky. I mean, look, the EV market is growing somewhat. It's not growing hugely. It's not growing anywhere near as quickly as the number of new competing EV models that'll be on the market over the next 12 to 24 months from almost every automaker in the world. So, the issue with Tesla is the first mover in a segment that has been notoriously unprofitable and remains unprofitable. And all these other automakers are being forced to build electric cars, by the European regulations, to a lesser extent in the US by the California regulations. And so, they're being forced into this. And because they're being forced into it, they're going to have a lot of attractive models out there. They're going to be able to subsidize the pricing on these models by their more profitable cars. And Tesla's going to get crushed. Tesla had this window of having essentially a monopoly on luxury electric cars, and it still couldn't make money. And now that window is slamming shut. So, the analogy I use is Tesla is like the Palm Pilot when the BlackBerry came along, or it's the BlackBerry when the iPhone and the Android phone came along. I mean, being first mover does not mean you capture the market, especially because Tesla has nothing meaningfully proprietary. I mean, the easiest thing in the world is to get a bunch of smart engineers to design a really cool car. The hardest thing in the world is to build hundreds of thousands of them profitably, and distribute them profitably and service them profitably and adequately. That's sort of the moat that these other car companies have. I mean, Porsche is coming out with a tremendous electric car in a few months. Audi has a whole series of electric cars coming out. The first one is out already. Even Jaguar, in your home country, has a terrific electric car out in the I-Pace, and the next XJ sedan is going to be electric. And these guys all know how to build cars. Tesla has no idea how to build cars. And then, of course, there's the wild card of Elon Musk. The man is a pathological liar. He cannot deny having committed securities fraud here in the U.S. with that false buyout. Any other CEO would have been fired by his board in 2 hours for that nonsense. Tesla is a completely dysfunctional organization. It's got more senior executives fleeing like what's her name fled the Titanic, and Musk is going to be DiCaprio. He's going to be the guy who gets sort of left behind and freezes all alone in the water in this company.
Well, probably not as good looking, but we've got the Q2 earnings report this week. I mean, what could possibly come out of that earnings report that might allow you to reassess your bearish view even slightly?
Well, there's nothing real that could come out of that report. Now, Tesla makes up all kinds of metrics. It posts all kinds of forward-looking nonsense. And, look, that could make the stock go up. But look, I mean, we already see what's happening here in this quarter versus the last quarter in the first 20 days in terms of sales. And they're terrible. I mean, in the countries that we can see that in. I mean, there's certain European countries, Norway reports it, Netherlands reports it, Spain reports it actually on a daily basis. In the U.S., we have guys at, their various service centers who are sort of spot checking how many deliveries they're doing. So, this quarter is probably going to be down versus last quarter in terms of deliveries. It's going to be down a lot in terms of average selling price. Tesla cut prices again last week after cutting them multiple times already this year. So, just moving cars profitlessly. Look, Musk has tried to always focus investors' eyes on the growth aspects of the company without really any regard for profitability. And now he's defining growth as units, car deliveries, rather than revenue growth. Because again, what he's calling a record quarter is actually less revenue than the fourth quarter of last year. So, he just changes the metrics and the goalposts as he goes along. And look, I'll fully admit this is taking a lot longer than I thought it would. That said, the stock has way underperformed the NASDAQ over, 1 year and 4 years. And so it hasn't really gone anywhere in the last 4 or 5 years. If you look at a chart, I mean, it's gone a lot of places. It's very, very volatile up and down, but it was like in the mid 200s in 2014. And here we are in 2019 and it's in the mid 200s. It's just, there's a lot of noise in this thing on the way.
So we know there are a lot of sell recommendations out there from the analyst community, but I spoke to one Tesla shareholder, Ross Gerber, last week, and he said that the stock is facing, quote, complete manipulation by Wall Street. He said for every downgrade, we've seen the shares bounce. So how would you respond to Mr. Gerber?
Yeah, Ross is just dumber than a piece of toast. I mean, he has absolutely nothing fundamentally to say about this company. And I didn't hear Ross complaining about manipulation when it was going all the way up. And in fact, when Musk put out that phony $420 buyout, Ross was the first guy to tweet. His tweet was literally like, it's the Saudis and it's real. They're doing the right thing here, right? I mean, and of course it turned out to be total BS, that thing. I mean, Ross really has no fundamental grasp of anything. And in fact, on the way down, Ross even admitted that he was selling some of his stock to control risk. Listen, the same way I buy some on the way up to control risk. So there's not a lot of fundamental credibility with Ross.
Okay, so tell us more about your short position then. It's in cash and in calls, as I understand, selling calls. So where do the shares need to get to for you to take profit? What kind of size are we talking?
So it's a very large position for the fund. It's roughly, as of now, it's roughly 25% of the fund. We're short this. As far as, I mean, it's hard to really tell where our basis is on this thing because we've traded around the position so much over the last 4 years. We've covered some, we've put some back on. But, my guess is, and it's a very rough estimate, we probably get profitable if you include all of that stuff, not just the current basis, at somewhere when the stock gets south of 200 a share is probably when we start generating profits over the long haul. Our current basis is much higher than that, again, because we've traded around the position. We're mostly just short common stock. We're short a small position in calls that are just way out of the money. I sold some calls a while ago and collected the premium there, and we still have them. So that's how this thing is structured. The option premium to buy puts is very expensive, and the other thing is, it's a very active trading stock from 4 a.m. to 8 p.m. here, New York hours, and very few stocks are trading at 4 a.m. and Tesla is. So it gives you a lot of flexibility to just be short the stock rather than try to do this through options.
All right, now, in terms of the analysts as well, I mean, Wall Street broadly is expecting Tesla to return to profitability around the fourth quarter of this year. So, I mean, is that a risk? Could that derail your trade?
Well, I guess it would if they really become genuinely profitable, sure. But, well, okay, so there's two things to be said there. First of all, there's no way they're going to be profitable in the fourth quarter, in my opinion, at least on a GAAP basis. I mean, I don't, without getting too far into the weeds here, there's GAAP and non-GAAP, and non-GAAP, quote unquote, profitability eliminates some genuine costs that are non-cash costs. But, to your point, there's some point at which Tesla just gets revalued as a car company. I mean, companies such as BMW and Daimler and GM, these companies are selling at 6 to 8 times earnings. Tesla is selling it, like 100 times fantasy earnings that don't even exist. So, and it's not really growing fast. I mean, you're going to see this quarter, Q3, is going to be flat to maybe, roughly flat versus the year ago quarter. That's the first time they actually have to lap, is the expression we use, real comps from when the Model 3 was in full production. So, and if you look, the US is their major market, by far their largest market. US Model 3 sales in the first half of this year are down versus Model 3 sales in the last half of last year. So, yes, this last quarter they sold a lot, but in Q1 they hardly sold any. So, much fewer anyway.
Okay, so the US, of course, is the main market for now, but we know that we've got this rollout in China potentially in the pipeline. I mean, if this addressable market becomes a winner, the second largest economy in the world, surely that could be a game changer given the growth potential there.
Well, so first, there's huge competition in China, both in electric cars, both from the domestic manufacturers and the joint ventures. I mean, every major, manufacturer you can think of is a JV in China going on. Second, I mean, Tesla is not doing that well in China. So Tesla is currently selling the equivalent of about 40,000 cars a year in China, most of which are the Model 3. When they have their own factory there, they said they'll be cutting their price by around 13%. And this was, by the way, said a few months ago. They actually just cut prices in China. They're essentially eating part of that tariff now. So it'll be less than 13%. But let's say versus where they were priced last quarter, it'll be about a 13% price cut. Even if you doubled China sales based on a 13% price cut in the Model 3, they'd be selling 40,000 more cars a year there. But sales in Europe are completely stalled out. They'll actually have a decent quarter in Europe this quarter in the UK because there's a backlog there. They hadn't been building the right-hand drive cars. But once that backlog is fulfilled this quarter, Europe is going to be in decline. North America is in decline. And when you put those together, the added sales in China are not going to make up for that. And then, then they're going to have this small SUV or crossover called the Model Y is supposed to be out sometime next year. But everyone is coming out with a small electric crossover. Audi is, Mercedes is, Porsche actually is going to make the Macan as electric. That's a little further out, but I mean next year it's going to be, Audi and Daimler and there's a couple others coming out. And so they're going to not only have to compete against that, but they're going to cannibalize Model 3 sales. It's not as if, they'll double sales because they'll have the Model Y. No, I'll bet you 80% of the Model Y sales come out of the Model 3. I mean, that will just be the preference in a small electric vehicle. It's the same way that BMW 3 Series sales took a huge hit when they came out with their X3, and the X2 and their crossovers. And that's what's going to happen to Tesla.
Mark, good to speak to you. Thanks so much for your time.
Thank you very much.
That was Mark Spiegel, Tesla short seller and managing member of Stanphyl Capital. I'm Victoria Scholar, and thanks so much for watching IGTV.